Hello. Welcome to my channel. Today also we will do live revision session, and today will be the first chapter, ratio analysis. Continue. Last time we have not completed some of the questions. It's question number 1. Total we have 40 questions. Okay, let's do without any stoppage. Let's start. We don't have as much time to revise all this. Ratio are used for the many purposes in financial statement to determine the return on investment for a company. The numerator of the function used should be return on investment, means numerator should be investment income before non-recurring item. Numerator, denominator. Numerator income should be what? Income before non-recurring item after deducting preferred dividend. Is not correct. Income before non-recurring item before income tax. This is not correct. Income before non-recurring item plus interest expenses net of tax. This one. Degree of operating leverage of 3 at unit, means that what? %3 change earning before interest and taxes will cause sales. 1% change change or degree of operating leverage of 3 at 5,000 unit, means percentage change in 3% earning before interest and tax. 1% change in before interest and tax will cause 3% change in sales. This will be the option C. Option C will be the answer. And question number 3. Selected information from the accounting record of Dalton Manufacturing Company is as follows. Net sales 18 lakh, cost of goods sold for 2002 12 lakh, and inventories at the end of 2001 3,36,000, inventory at the December 2002 2,88,000. Assuming there are 300 working days for your average number of days inventory. Average number of days inventory. First we have to calculate inventory turnover. Inventory turnover, we will calculate average inventory. First to calculate inventory turnover, we have to first calculate the to calculate days in inventory, number of days in inventory. First we need to calculate inventory turnover, and secondly we have to calculate days in inventory. That will be the process. To calculate inventory turnover ratio, we have to make average of inventory first. Okay, 3,36,000 opening and closing 2,88,000. Its average comes to 3,12,000. And first we have already given cost of goods sold 12 lakh divided by 3,12,000 is come to the 3.84. And the inventory days is 300 divided by 3.84 is going to 78, means 78 days is already given there in answer. Okay. And now question number 4. The common stock of the beverage company has the current market price 34. Beverage company's estimated earning per share 2. Average price earning ratio of companies in the beverage industry is 50. Market price 15. Using the price earning ratio, company average price earning ratio of a company in the beverage industry is 15. Market price means using the price earning ratio as the comparable valuation method. The beverage company's stock price we have to calculate. Okay, first of all we have given the common stock of the price is 34 and 2 17. Okay, it's come to 17 and market is 15. It means to overvalued. Now question number 5. Account receivable turnover will normally decrease as a result of account receivable means debtors turnover means credit sales divided by average debtors will decrease as a result of change in credit policy length of. This one first option is correct, no need to change other. Return on investment is used as an important measure of how effectively management is using the capital investment in company. If the standby company has sales of 100,000, net income is 15,000 and assets of 400,000, organization's return on investment increase. If company sales 100,000, net income 15,000 and assets is 400,000. Net asset are purchased resulting in increased sales but the same net income. Net income is increased by the same dollar amount. The total assets are increased. Net income is increased by the same percentage as total asset. Sales are increased by the same dollar Return on investment is used to important measure how effective management is using capital invested in company. If the return by company sales at net income 8,000 asset 4,000 return investment. If new asset are purchased resulting in increased sales but same net income. First is option is not correct, and second option, net income is increased by the same dollar amount. Total asset are increased. Net income is increased by the same percentage total asset. Sales are increased by the same dollar amount. Yes. Net income increased by the same percentage as total asset. Question number 7. How did the total asset turnover ratio and return on asset change respectively? Both increase. This is already done. Now in question number 8, PE ratio 12, payout ratio 0.6, asset turnover 0.9, dividend yield 0.9. be dividend payout. PE ratio means market price divided by EPS equal to 12. What is the market price? Asset turnover ratio, income divided by asset 6, payout ratio 0.6. This case PE ratio divided by this, we have to calculate this is PE ratio 12 and payout ratio 0.6, asset turnover ratio 0.9, dividend yield we have to calculate, right? PE ratio 12, payout ratio 0.6, asset turnover 9, dividend yield. This is very short but technical thing. Technical. Payout ratio divided by P ratio. Payout ratio, okay. Payout ratio divided by PE ratio equal to dividend yield, okay. Payout ratio how much? Payout ratio is 0.6 divided by P ratio how much? 12 is come to 5%. Is there any 5%? This is the dividend yield, okay. This is technical, very short, but is critical, and we have to memorize this formula. If there is a given P ratio and payout ratio, then we have to calculate dividend yield. In that case, it just will take a few seconds to calculate. But if you don't remember this formula in exam, we cannot solve that question, because this is tricky questions. If you give more time, you may solve biologically, but in exam we don't have a time. We have to save time as much as possible, and if we remember this formula, dividend yield equal to payout ratio divided by PE ratio. Simple. Payout ratio divided by PE ratio equal to dividend yield. If we remember this formula, we can solve within the fraction of second this question, right? Let's use of the following financial statement. There is a financial statement given, and cash is given, receivable given, inventory given, total current asset given, plant asset given, and total asset also given, account payable given, notes payable given, other current liability also given, current liability total given, long term liability, common stock, retained earning, and total liability also given, liability and equity, common stock and retained earning, everything is given. And also given the income statement, sales given, and cost of goods sold given, gross margin given, selling expenses given, admin expenses, earning before interest and taxes, interest expense given, income before tax given, income tax given, net income also given. What we have to calculate in this case? The profit margin on sales, profit margin on sales, profit margin, return on total assets. Return on asset means total net income divided by average total assets, that will be the return on asset formula. Okay, profit margin on sales means profit divided by sales, that will come profit margin. And return on common equity, return on common equity means after tax, if there is a prepaid dividend, after payment of prepaid dividend, that will come to the return on common equity divided by number of share outstanding. Okay, that will the formula. And these are the three we have to calculate here. Okay, first we have to make one trick here. How can we choose the as far as fast as possible? In this case, there are three questions, right? Three questions we have to calculate. In this case, if we calculate one and that is matching somewhere else, here are three, then we have to directly select that one, other definitely will match, right? If that is not matching, then we have to eliminate the question options. In this case, we can save this time, and we cannot calculate three requirement here. Only we have to calculate one or maximum two to select the options. No need to calculate three. If we calculate one or two, definitely we can find easily best option here. Suppose I will give the example here. How can we calculate? Suppose I calculate for the return on total assets. Okay, already return on total assets, how much income is given? 84. Okay, and how much total asset I have? Already given asset, total asset already given here. Return on total assets. Okay, income is given. Income is 84 divided by, and assets is given 2270. Total assets, okay, into 100 is 3.7. I have to sort 3.7 where? 3.7 is coming in option B. One I calculate, and already option is correct. This one is also return on asset 3.7. Okay, and then no need to search other option because I calculate only one, but that is correct. In other option 3.7 return on asset not given. It means only one option is correct. No other need to calculate. If I calculate one option, all other automatically will match, because we have to save the time. Question number 10. Okay. In the questions, there is given cost and expenses detail. Okay. Cost, direct material cost given 200,000 is called also 2 lakh. Direct labor given 1,50,000, and factory overhead given 70,000, and fixed overhead also given fixed cost 42,000, and general selling and admin expenses 30,000 variable cost and 48,000 fixed cost. Okay, total variable cost how much? 4,50,000, and fixed cost 90,000. It's not 9,000. It's down. Okay. What question is exactly asking? During the year 2001, RHO produce 3 lakh units of industrial photo frames, which were sold for $2 each. Okay, how much will be 3 lakh produced into 2? How much sales equal to 6 lakh. Okay, also investment, that is investment was 5 lakh and 7 lakh at January 2001 and December 2001. It means we have to calculate average investment. Opening and closing is given, okay, respectively. And normally inputs interest on investment rates is 15% average investment on capital for the year ended December 2001. Rose return on average investment was. Return on average investment we have to calculate. Return on average investment, we already talked about this one. We have to average the assets already given 5 lakh and 7 lakh divided by 2. How much will come? I hope 6 lakh will come there. Okay, and we have already sales 6 lakh and variable cost already given. How much? 4,50,000. Okay, and fixed cost how much? 90,000. Total profit how much? 6,000. Okay, 60,000 is coming net. 60,000. Okay, 60,000 divided average investment how much? 6 lakh, and it's come into 100. It's 10% is coming. What is the 10%? Exactly, this is 10%. Okay, no need to calculate all that. Simple. Okay, now question number 11. We don't need to read all this one because we don't have much time. Suppose this one financial analyst, all these are the story. Okay, just story. Basically we need to read only those requirement, and here is the given. Company A, company B and company C, 3 company are given there, and net credit sales given. Also company A, company B, company C, net credit sales is given, average account receivable given. Okay, and average allowance for, that is uncollectible accounts. Uncollectible means what? That is we cannot collect, bad debt, whatever. Okay, is given if each of the companies has credit terms of 30 days. Okay, it means if we sales one credit sales and we the debtors is liable to pay within the 30 days, the financial analyst is most likely to conclude which one of the following: credit sales given, average receivable given. Means what? We have to calculate receivable turnover ratio. If we calculate receivable turnover ratio, what will be the receivable turnover? Receivable turnover ratio, 175,000 credit sales divided by average receivable is 10,000 is come to the 17.5. Okay, and company B, 145,000 divided by 20,000 is come to the 7.25, and company C, 1,25,000 divided by 11,500 is 19.56. It means highest is how much? 90.56 and 90.56, and for first one is 175,000 divided by 10,000, 17.5. This is a given credit term is 30 days. That is why company A is the most efficient in the collection payment. Company A is not, company C is the most. Company B is more efficient than company C. Average credit sales, this one, and average account receivable net. Company B is not. Company C is less efficient than company A collection period. Company A is most efficient. 2,25,000 divided 11,500, 19.5. Company C is efficient, not company. Company C is less efficient than company A in collecting payment. Company is most efficient in collecting payment. Company B is less efficient in collection payment. Company B is less collection efficient. Company B, because day collection period, how can we calculate? Means when we calculate the turnover ratio, receivable turnover ratio, that ratio will come and divided by 360 divided by that ratio, and company B is coming 145 divided by 20,000 equal to 7.25. 360 divided by 7.25, if I calculate, it's come to the 49 days. And other company are taking, suppose the company A, I take the options, and company A 175,000 divided by 10,000 is 17.5. 360 divided by 360 divided by 17.5, if I make, is come to around 20 days collection period, and it means company B is the less efficient in collecting payment, right? This should be the correct answer. Okay. Now in question number 12. Question number 12, receivable given, account payable given, bond payable due within a 10 years, it means long term given, cash given, interest payable due in 3 months given, inventory given, land given, note payable due in 6 months given, it means short term, prepaid expenses given, this is current asset. Okay, company has an operating cycle of 5 months. Current ratio, just need to calculate. What is the current ratio formula? Just to calculate current ratio formula is current asset divided by current liability. Okay, what is the current asset? First we need to calculate total current asset. Receivable is current asset. Okay, fine. And cash is current assets. Okay, how much cash? Cash is 1 lakh. Okay, cash 3 lakh. Interest payable due within 3 months is a liability, not asset. Inventory is 4 lakh. Okay, this is also current asset. Total 7 lakh. Land is not current asset, and note payable, this is current liability. Prepaid expenses also current asset, 40,000. Prepaid expense 40,000, and inventory 4 lakh plus cash 1 lakh plus 2 lakh. Receivable, total 7,40,000 current asset. Okay, 7,40,000 current asset. Liability, how much? 80,000 is liability. Okay, bond payable due 10 years, this is long term, not short term. Interest payable due in 6 months is 10,000, this is current liability. And land is inventory, not this assets. Note payable due 6 months, 50,000. Total liability 1,40,000. Okay, 7,40,000 divided by 1,40,000, how much? Is come to 5.28. Is there 285? 5.28, 5.29 is there. This is a round figure. And now question number 13. Okay, now in question number 13, I think this one is quite lengthy question, and better to do this one. Already we did question. Better to skip this question. No. Question number 14. Account receivable turnover given, return on asset given times interest on. Time interest on means how? What? Time interest on, we calculate EBT divided by EBIT is time interest on. Formula simple. EBIT we have to calculate EBT, earning before interest and tax, divided by EBT, EBIT, earning before interest and tax, divided by EBT, earning after tax interest. It means interest portion, how much interest portion is there, we have to calculate that ratio. Simple. Okay. Current ratio given, debt equity ratio given, degree of financial leverage given, and price earning ratio also, PE ratio also given. Okay, this already we have solved, I think. On the basis of this information, which one of the following is the best initial strategy for Halifax to follow the attempting to improve the flexibility of Strickland? Seek additional source of outside financial new product, introduce, seek a cost cutting measure that would increase Strickland profitability, increase Strickland investment in short-term security to increase the current ratio, investigate way to improve the asset efficiency, turnover time to improve liquidity. Yes, option A may be the suitable for this one, because degree of financial leverage is less than its competitor, and if he seeks outside financial assistance, which will maintain average to the competitors ratio, and the Strickland can borrow the money. And now question number 15, which of the following inventory cost flow assumption will result in higher inventory turnover ratio in inflationary invoice? Higher inventory turnover ratio means how? LIFO means first in first out, and it means if first in first, LIFO means not first, LIFO means last in first out. Last in first out means today purchase, today out, today sale. In that case, what will be the result? Last in first out, first in first out. Last in first out. Last in first out, what will be the result? Last in first out will result inventory will be lower, because inventory will be the first purchase that is old, and inventory will be lower. Inventory lower means ratio high, FIFO, weighted average, LIFO. LIFO. Okay. And now question number 16. In question number 16, there are given cash, account receivable, January and December. It means beginning and closing is given, trading security given, inventory given, plant and equipment given, account payable given, accrued liability also given, deferred tax given, long term bonds payable given. Okay, net income also given 96,000, and current ratio at the end of the year. Only current ratio need to calculate. What would be the current ratio at the end of the year? Current ratio simple, we don't need to make the average because we are not comparing with the P&L items. Okay, current ratio at the end of the year will be the cash given 62,000 plus account receivable given 47,000, and trading securities given 25,000, and inventory given 138,000, inventory given, plant and equipment not current asset, and total will be 282,000 will be the current asset total, and current liability will be 84,000. This is the account payable, and liability 11,000 plus deferred tax is not current asset. We don't normally consider current asset deferred tax, and 95,000 is 282,000 divided by 95,000. How much is come? 2.968. It means 2.97 is the correct answer. Okay. Now in question number 17, let's go for question number 17, and question number 17 is, I think this is the easiest question, right? Given that account earning before interest and tax EBIT 7,50,000, interest expenses given 1,25,000, income tax given 40%. Okay, do you know how can we calculate the degree of financial leverage? Degree of financial leverage, first we have to calculate EBIT already given. Okay, already tax given. We already have calculated too many times this one formula also. Simple formula and simple questions. There is no hard and fast. Simple equate already given 7,50,000. Any interest reduced 1,25,000. 7,50,000 minus 1,25,000 is come 7,50,000 minus 1,25,000. It's come to 6,25,000. Okay, 7,50,000 divided by 6,25,000 is come to 1.2. 1.2 simple. All of of the following are affected when market is purchased on credit? Except all affected except credit purchase. Net working capital will affect definitely. Affect? No affect. What purchase? Credit purchase. What purchase? Total asset current ratio, total current liability. Credit purchase, current liability will increase. Net working capital, current ratio. Current ratio will affect depend on the how much current total current asset and total current liability depend on the current ratio that will affect total current assets. Credit purchase, current asset will increase. Net working capital will not affect. Simple. Question number 19. A company has a return on equity 18%. This one already done. I think this is very much simple questions already done. 18% multiplied by 0.4 equal to 7.2. This is not a hard question. Now in question number 20. I think this is repeated question or what? This return on equity to increase. The question has given Colonel INC expect to report net income at least 10 million annually for the foreseeable future. Colonel could increase its return on equity by taking which of the following actions with respect to its inventory turnover and use of equity financing. Option A, inventory turnover and use of equity financing both increase. Option B, inventory turnover decrease and use of equity financing increase. Option C, inventory turnover and use of equity financing both decrease. Option D, inventory turnover increase and use of equity financing increase. Okay, now question number 22. There is given beginning of the year and end of the year. Inventory given. And inventory beginning of the year is given 6400 and end of the year 7600. Account receivable given 2140, 2140 and 3060. Account payable, everything given, simple. And total sales for the year were 85,900, which is 6200, 400 were credit sales. The cost of goods sold were 24,500. This is asking for inventory turnover ratio, and this is a repeated question as well. Inventory turnover ratio, inventory average inventory, we have to calculate 6400 plus 7600 divided by 2 is come to 7000. And cost of goods sold 24,500 divided 7000 is come to 3.5. This is correct answer. Okay, this is very simple. Now question number 23. If a company has a current ratio of 2.1, pay off a portion of its account payable with cash, the current ratio will, what will be the changes? Simple, there is a trick. Okay, and if the ratio is positive more than 1, then to increase to the ratio, pay the liability. And if the ratio is less than 1, to improve the ratio, buy on credit. Okay, or sell on credit, that will increase your ratio. In this case, current ratio is more than 1, 1.2 is more than 1. In this case, we have to improve. No, we are paying the cash, we are paying the payable in with cash. It means payable also will reduce and cash also will be reduced, but proportionately payable will affect more than total assets. In this case, in that case, the ratio will improve, mean increase, right? Option B. Now question number 24. Now question number 24. And company, the preferred stock. Preferred stock is given par at 100, non-convertible. Okay, common stock also given 2008 and 2009, 2 years data is given. And dividend paid, common stock. Return on also given, common stock given, dividend paid on preferred stock, your in debt 10,000, 10,000. Net income for the year ended 60,000, 120,000. Return on common share need to be calculated. Okay. What will the total outstanding share? Outstanding share common stock is given. Okay. 3 lakh given. Opening closing 4 lakh plus 7 lakh plus return earning 75,000, 185,000 divided by 2 is come 4,80,000 average. Okay, 4,80,000 and 1,20,000 is the net income minus prepaid dividend 10,000, 1,10,000 divided by 4,80,000 equal to is come 23%. 23% is correct answer. I hope so. Okay, question number 25. A company has sales 1,60,000, variable cost and fixed cost 40,000. And what is degree of operating leverage? Profit is 10,000. It's come to the net profit 10,000. Okay, and contribution is 40,000 divided by 10,000 is come to the 4. Is 4 answer. Question number 25. Cash given, marketable security given, account receivable given, inventory given, long-term investment given, net land given, total asset given, liability given, account payable given, accrued payable given, short-term notes payable given, long-term debt given, common stock given, return earning given, total liability given. Okay, and if A uses 25 cash to pay 24 account payable, what will the now current ratio? Okay, now it is asking about same question earlier we did, and current asset how much? Total current asset 2,000 minus long term investment 150 minus and planned 112. Current is at 500 and current liability how much? Okay, now current liability, if I calculate current liability, 2000 minus equity, return earning 300 minus 1000, common stock minus long term debt 300 equal to 400. Okay, 400 current liability. Okay, and 400 minus 25 equal to 375. 500 minus 25, 475, 375 equal to 1.27. 1.27 is the correct answer. Okay. Has current ratio is 0.5. Which of the following will increase the ratio? Already we talked about these questions, right? Current ratio is if the less than 1, what will we do to improve the current ratio? Already we discussed. If current ratio is less than 1, buy in credit or sell in credit, that will increase the ratio. Use the cash to pay current liability. This is not a correct answer. This will reduce more. purchase additional inventory on account. Account means credit. This is correct answer. And you just pay up the supply, right? Already we paid purchase in credit. Purchase in credit. In this case, our credit will inventory will increase, then ratio will be improve. Okay. There are given 4 company, I think, right? Sales given: Comgo, Astor, Saizen, Industry given. Total sales given. Total sales given in million. Net profit margin also given. Okay. Net profit margin given. Current ratio given. Return on asset given. Debt to equity ratio also given. Financial leverage also given. Okay. Based on the information above, select the strategy that would fulfill the objective. What is the question exactly saying? The Stone Bank has received a loan application from the 3 applicants, okay, in the computer service business, and will grant loan to the company with the best prospect of fulfilling loan obligation. Specific data shown below. Then selected this applicant review the company's industry average. Now, this question company are applying for loan, okay, and both bank will decide whether loan to be granted or not on the basis of their financial statement. And what will check by bank? Bank will check their ratio and net profit margin, current ratio, return on ratio, debt equity ratio, and debt coverage ratio. As per bank policy, they will change. Okay, and the same thing is question is given here. And financial leverage is simple. Financial leverage means how much loan already we have taken to run our business, and on the basis of that, the ratio will be decided. Okay, and here is option is given. Stone should grant loan to Comgo as all the company's data approximate industry average. Comgo total sales is average, correct. Net profit is also correct, that not much different. Current ratio also quite lower as compared to other. Return on assets quite lower as compared to Astro and Industry. Debt to equity ratio debt to ratio is quite higher, and financial leverage also quite average. It's not much. Eastern Central grant loan to Astron has both debt to equity ratio and degree of financial leverage is also be also possible, and debt to equity ratio is correct, and degree of financial leverage also lower. Social grant to loan Shenzhen company has the highest net profit margin. Degree of financial leverage, no, degree of financial leverage is higher. It means debt to equity ratio also high, and net profit margin not that much high, and you can say something from 0.5% high. Students should not grant loan to none of this. This is not a question. Question D is eliminated itself. It means Stone has increased its profit by utilizing the outside debt, right? And as Stone, not debt to equity ratio not much different. Current ratio high, and return assets high, more utilizing stock. This one, option B is correct. Now question number 29. Good stock unlimited wishes to pay dividend to stakeholder. However, management is concerned about the effect that might have solvency position of the organization. What effect would be the payment of cash versus stock dividend have on the total debt total capital ratio? Cash dividend versus stock dividend. Cash dividend means we are paying cash through our reserve and surplus to the shareholder. Okay, and stock dividend means we are paying dividend instead of cash. It means their shareholding will increase. Cash dividend increase. What effect would be payment of cash versus stock dividend on debt to total capital ratio? Debt to capital ratio. Debt means capital will not increase. Cash dividend decrease. Stock dividend capital ratio, total capital will not increase. To debt to equity, debt also debt to capital will increase. This cash dividend will decrease. Debt will not decrease. Cash dividend will decrease. Stock dividend will no effect. Stock dividend will be no effect. Cash dividend will decrease. If capital will reduce, stock dividend will no effect. Cash dividend increase. Capital will less will cash dividend will increase. Debt to equity, debt also equity increase, no effect. Okay, now in question number 430, comparing the ratio of the company against the same ratio for a group of companies for the same industry is example of comparative analysis. Now we have question 9 remain. Company is currently reviewing the most recent fiscal year result of operation and noted an increase in return on asset ratio. Return on asset when comparing to the prior year, which one of the following could have the increase? Return on asset increase, it means either asset decrease or income increase, right? Sales remain same and expenses and total asset decrease. Expenses decrease, total asset decrease. This can be happen. Sales decrease, same dollar amount, expenses increase. This is not. Sales increase by the same dollar amount, expenses and total assets. Same, the sales remains same and ending inventory inventory. Sales remain same and expenses and total asset decrease. Income increased or total asset decrease. Simple. Basic earning per share in computed by basic and percentage dividing net income ending common share outstanding. Basic earning per share is computed by dividing income available to common shareholder by weighted average common share outstanding. This one is correct. Net income. Net income. Income available to common share dividing income available. Which of the following ratios are useful in assessing the liquidity position of company? Current ratio given. Lakh divided 2.3. चार 40,10,800 below. Okay, for given level of sales or holding, all other financial step constant, company return on equity In the given question, there are three companies. Okay, sales, three companies sales given, gross profit margin, three companies given, beginning of inventory given, ending of inventory given. On the basis of this data, the company A and company C are both turning product inventory faster than company B. Okay. It means we have to calculate gross profit margin. 20% means what will be the 1 million is 80%, 8 million. Okay, that's 8 million plus 20% equal to, no, it will come. Gross profit margin 20% means इसको 20% means 8 lakh. Okay. Minus 20%, it's 75. Okay, and 50,000 minus 25%, 18 lakh 37,500. Okay. Average 155 plus 175 divided by 2, 65. 165, 18 lakh 375 divided by 165,000. Inventory turnover 11.13 means 11.13, 360 divided 11.13 equal to 32 days. Okay, and this one 80,000, 22 days, 80,000 plus 25,000 divided by 2, it's come to 152,500. 152,500. Direct answer minus 25% divided by 152,500. 6.16, 360 divided by 6.16, 58 days, that is what 22, and 80,000, 35,000 plus 64,000 divided by 250,000 and 50,000 80,000 equal to 16. 360 divided by 60, 22 days only. Company A and C both turning product inventory faster than B. Option B is correct. Company C is turning product fastest, B is turning. Option A is correct answer. Okay. Now in question number 37. Okay. There are two company given, A and B, and net sales both given, cost of sales also given, net income given, total asset also given for both company. When comparing the two company, which of the following statement is correct? Two company we are comparing. Okay, Company A has lower gross profit margin and higher net profit margin. Gross cost of goods sold. Gross profit margin means 1530 means yes, company A has lower and net profit margin. Net income, company has lower, higher. This is correct. Company has higher gross profit margin. Not correct. This is not correct. Company has higher gross profit. This is not correct. Company has lower profit margin and lower net profit margin. Net profit margin. Company. This was correct. Now question number 20. Which of the following combined transaction would use net working capital decrease? Net working capital decrease. Net working capital correlation and correlativity. Okay. And 1 million increase in cash and 1 million increase in long term debt. This will not decrease, this will increase. 1 million decrease in cash, 1 million increase in inventory. No effect. 1 million decrease in cash and 1 million decrease in account payable. No effect. 1 million decrease in cash and 1 million fixes. 1 million decrease in cash and 1 million increase in fixes, and this is good. Okay. Now question number 39. Davis company has a short-term cash need and plan to take out 120 days promissory note. With effect, will this transaction on the long-term debt equity ratio and the equity total debt ratio? Long-term debt to equity and equity to debt ratio. Long-term debt to equity decrease. This is wrong. Long-term debt to equity no change. Equity to debt decrease. Equity to debt will increase, not decrease. Long-term debt to capital decrease. This is wrong. Long-term debt to equity no change, and equity to debt will increase. Equity to debt increase. Equity to debt decrease. Okay. Now question number 40. Cash given, marketable security given, account reserve given, inventory given, prepaid expenses given, account payable given, long-term debt, current portion given, long-term debt, long-term given, sales also given. Quick issue means what? First cash coming, marketable security also coming, account receivable also coming, inventory not coming, prepaid expenses not coming, account 1,48,000. okay, and prepaid expenses not coming, and account payable 75,000 plus long-term debt current portion 20,000, 95,000, 148,000 divided by 95,000 it's come to 1.55, 1.56. Okay, now let's go to the, we have finished, let's check 93% we have a score, and only 3 questions is mistake. I think this is good enough to pass in exam as well, and 93% Only 3 questions. Maybe there may be some mistake, but hopefully that will also be corrected soon.